Market Journal, television for agricultural business decisions, is a presentation of the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources.
Promotional support is provided by the Nebraska Farmer Magazine.
Welcome to this week's edition of Market Journal. I'm Jerry Renaud. On this episode, Todd Hultman looks at corn and soybean markets. Brad Lubben gives an update on the 2018 Farm Bill. Lee Schulz analyzes the USDA quarterly hogs and pigs report. And Amit Jhala shares information about the upcoming Glyphosate-Resistant Palmer Amaranth Field Day. Todd Hultman from DTN is our market analyst this week. On July 2nd, the USDA released its latest crop progress report. The report showed 76% of corn was in good to excellent condition, just down 1% from the previous report. This rating remains the highest since 1999 for corn. The report also lowered its good to excellent rating for soybeans to 71%, only 2% lower than last week. That's also the highest good to excellent rating since 2014 for soybeans. We met with Todd on Tuesday to learn more about how the weather and the expected tariffs between the U.S. and China will affect prices and exports, but began by asking him for his analysis of the crop progress report.
Well, on the planting side, for the first time since 1983, we have more soybean acres than corn. That's something new and different to get used to. It's a trend that's been coming on for a long time, and this time they finally crossed. It's not a big difference, about 89.5 million acres of soybeans versus 89.1 million for corn. So they're still very close, but this is another part or sign of world demand growing for soybeans and protein all the time.
Let's talk a little bit about the crop progress report, and I know there's a little bit of a dichotomy in terms of some weather issues, in terms of maybe some hail damage and flooding.
Yes, absolutely. You know, we've got in the northwestern plains here, we've got several areas where there's been flooding problems. We've had serious hail, and yet USDA's crop progress report comes out with very high crop ratings for both corn and soybeans once again this week. They came down slightly, but we're still looking at a very good crop potential for the 2018 season. That's very tough, I understand, for a lot of farmers who are in those distraught areas, but overall we've had widespread beneficial rains for the Corn Belt in general, and that's why those crop ratings are staying so high. We've seen it in other years where there's been areas where crops did not do well, we had flooding problems, and yet when we get to fall we still have a big harvest. So far it's looking somewhat like that.
Let's talk a little bit about prices. A lot of things are impacting prices right now. Let's talk about some of those issues.
Yeah, well, the month of June has been very tough on our corn and soybean prices. Corn down roughly 50 cents since late May, and soybeans down roughly $1.50 since late May. So those are significant drops, and it started with good early crop conditions for both corn and soybeans. As we got the corn and soybeans planted, we actually had a pretty nice month of May for all the planting activity, so that all went well. And then on top of that, we have this trade situation with China, the world's largest buyer of soybeans that we're having a dispute with right now, and that adds to bearish concerns on our grains, but in particular our soybean prices.
Let's talk a little bit more about those tariffs. What do we think is going to happen there?
Well, Jerry, it doesn't look good at this moment. So far, it looks like on Friday, July 6th, that is the deadline when China is expected to enact a 25% tariff against U.S. soybeans. Now, it's going to be charged to those who import soybeans, so it's actually charged to the Chinese businesses that are bringing the soybeans in. There is a possibility, and I can't say we have anything firm yet, but there is a possibility that the government may find a way to ease the burden on those importers, because the bottom line is China still needs U.S. soybeans. Brazil had a record crop this year, but that export supply is not going to last them forever. Sometime this fall, I'm thinking possibly late September, early October, China is most likely going to still need to start buying U.S. soybeans again for at least a 4-month period. So the government may find ways to help their importers. Of course, if they do, that would help the volume flow from the U.S. But the bigger concern is that as long as relations between the U.S. and China are somewhat hostile or adversarial right now, China is going to continue to just minimize their U.S. soybean purchases and get as much as they can out of South America. So That's the longer term concern for our U.S. producers.
Another area of concern with trade is NAFTA.
Yes. And there again, a couple of our best ag trading partners, Canada and Mexico, and we still don't have an agreement yet. The president said the other day he doesn't really want to sign anything until after the fall elections. So we'll have to see how that goes. But Mexico in particular has been a wonderful buyer of our grain products this year, and we need those relationships to continue.
Now, the value of the U.S. dollar is also having some impact?
Yes. The U.S. dollar's been rising. The bottom line there is the U.S. economy continues to outperform the other major economies of the world, Europe in particular. That helps us have a rising dollar, but it also makes our grain exports a little more expensive. So that just adds to the tariff concerns we have right now. And along with that scenario is the thought that we're going to continue to have gradually rising interest rates in the year ahead. So those two kind of go hand in hand. And of course, our U.S. producers don't like to see higher interest rates at a time, especially when our grain prices are low.
So let's ask you to make a prediction. What's going to be happening in the next few months?
Well, it's all going to come down to weather, which is no surprise. Weather is always the key each year. If the weather continues to be generally favorable for the Corn Belt region, I think it's going to be very tough for our December corn prices to move much from where they are from right now, which is around the 360 area. We still have pollination in front of us. There's a concern about hot nighttime temperatures and the forecast for pollination time. That has been known to reduce yields. We'll have to see how that plays out, but I think as we look right now, we can't say that there's going to be any significant production hit yet. Similar for soybeans. We're looking at November prices below $9 a bushel right now. Of course, a lot's going to happen depend on what happens Friday with the tariff deadline and how the U.S. responds to that and how that continues to play out. But right now, it's hard to give much bullish hope for either one. I will say the one thing that's supporting our corn prices right now, USDA's estimate of world-ending corn stocks is lower for the season ahead. So there is a significant reduction there, which should help corn prices have better support through this time. But once again, it all comes down to if we have big crops in the fall, it's going to be hard to get anyone to encourage to be buying corn or soybeans.
Next week, Doug Simon from Tradus will join us to look at corn and soybean markets. The 2018 Farm Bill came one step closer to reality last week when the House of Representatives passed its version. According to Nebraska Extension Policy Specialist Brad Lubben, there are a number of differences between both the House and Senate versions of the bill. A few of those differences include the Farm Income Safety Net, conservation, and the SNAP program. We talked with Brad Monday morning and asked him for an update on the 2018 Farm Bill.
Well, we now finally have a bill that has passed both the House and a separate bill that has passed the Senate here both in late June. So we can proceed to what's called a conference committee, where we theoretically iron out the differences and move forward towards final passage.
Let's talk about some of the things that are in the bill. Where are the differences as you see them that are the important ones?
We can look at lots of issues in all of the titles of the bill, but remember there are four sort of fundamental areas where 99% of the spending is at. Commodity programs, crop insurance programs, conservation programs, and nutrition assistance, or the Supplemental Nutrition Assistance Program. Those are where some of the differences are that we can pay closer attention to and think about. In the commodity title, we have been living with what's called the ARC and PLC programs. We really do expect that to continue. There are some proposed revisions on the edges of those programs. Both the House and the Senate propose to adjust the ARC program in terms of the yield data, a push that farmers across the country were arguing for, to use more crop insurance data in that yield calculation. The Senate also proposes to slightly strengthen the ARC program by virtue of changing the yield formula to a trend-adjusted yield. So instead of a historical average, it's a trend-adjusted historical average, which should theoretically increase the guarantee a bit for producers. By comparison, the House doesn't do much to ARC other than the yield formula, but the House proposes a slightly higher reference price if and when market prices ever rebound above current reference prices. So the House does have some more focus on PLC, the Senate has more focus on ARC. They're relatively minor differences to be worked out here in conference.
How about conservation?
Conservation's a bigger difference fundamentally between the two. There have been arguments for trying to increase the size of the CRP program, given that it's shrunk down to its current cap at 24 million acres. The House proposes to bump that up to 29. The Senate proposes to bump it up to 25. How do you pay for more acres? One of the ways is a proposal to cut back on the rental rate that can be paid on those acreage caps. The House would cut that back to an 80% cap on of 80% of local cropland rental rates to be the maximum CRP payment. The Senate would propose an 88.5% cap. So there's give and take in both. We'll see where it plays out. The Senate and the House do differ substantially, however, on working lands. Currently, we have this EQIP program, Environmental Quality Incentives Program, that provides cost share type assistance to producers to adopt new practices. We also have the Conservation Stewardship Program, or CSP, that provides stewardship payments to continue doing good practices. The House proposes to eliminate CSP. It would roll the stewardship component into EQIP, but in the end it would give something like 2/3 of the current money going forward. The Senate fundamentally proposes to keep both EQIP and CSP in place. It proposes a minor cut to funding on both, but you have a very different vision of what conservation programs should look like going forward in the House versus the Senate.
How about in nutrition?
We are fundamentally left with the major difference in the Farm Bill between the two versions. The House proposed a substantial cut in terms of benefits by tightening up some of the eligibility and calculations. The House also made a major shift in pushing tighter work requirements, but supplementing that with a broad jobs and educational training program to help those individuals find gainful employment that moves them off of SNAP benefits over time. In the end, the House fundamentally spends about the same amount of money, but they fundamentally imagine that going to training that gets individuals off of assistance over time. The Senate fundamentally maintains current benefits and rules, tightens up some of the eligibility guidelines, and tries to eliminate some of the potential abuse or waste in the program. That still remains the major difference between the two that has to be sorted out.
So all of this has to be worked out in conference. What is the schedule? How is this all going to work out?
You know, now that we have a bill from both the House and the Senate, staff members in D.C. could already be working on differences. Conferees need to officially be named. That could happen here in early July, and then we move to formal proceedings that could really wrap up by August, or at least in August. We could see a final bill come back from that conference committee for consideration in both chambers before the current Farm Bill expires in September.
Do you think there will be a lot of conflict in trying to resolve some of these things?
Most of the issues, I think, are resolvable. There are differences clearly between the two bills across the spectrum, but they're the kinds of issues we always debate. One thing to mention, neither one fundamentally touches crop insurance. While there was a debate in both chambers, the program's effectively status quo. So there aren't major differences in the farm components of the bill. The big difference is SNAP, and the question to be resolved is, can you find a compromise version that can actually pass both chambers? That'll be the test that we get to watch for a couple months here.
As Brad mentioned, it's possible a compromise bill could be sent to each chamber by late August or early September before the current bill expires, or the final vote may not be held until after the midterm elections. Our hog market analyst this week is Iowa State Extension livestock economist Lee Schulz. According to the recent USDA quarterly Hogs and Pigs report, the United States hog inventory of all hogs and pigs as of June 1st was 73.5 million head. That's up 1% from March's report, up 3% from last year, and is the highest June 1st inventory since estimates began in 1964. In addition, breeding inventory and the hog market inventory were both up by 3% from last year. We talked with Lee on Monday and began by asking him for his analysis of the report.
Well, last couple of reports, there hasn't been too many surprises. They were very much within pre-report expectations. And I would couch this report as really the first one that kind of threw us a little bit of a surprise. And it really came in that breeding herd. And we can talk a little bit more about that. But as we walk through some of the other estimates, I think when you look at the market hog inventories, that was very much within pre-report expectations. The breakdown of those inventories really suggests slaughter should be as we expected. If there was maybe a little bit of surprise, it was that near market ready category. And that's going to be the slaughter really mid-July through August. That could be a little bit heavier than anticipated, but I don't think that's really going to cause all that much of a shock to the market, as really we've seen those numbers within pre-report expectations.
Why do you think that was a surprise?
Well, I think the surprise came with that breeding herd. And when this number came, 3.5% year-ago levels, I think that was really a surprise to many. If you put that into a bit of a context, the last time we added over 100,000 breeding herd additions to the inventory from March to June was back in 1997. So it's been several years since we've added that many over one quarter. Also, you really can't take this report at face value when you look particularly at the farrowing intention numbers. So right now, farrowing intentions for June and August, and then September and November, were only 1.5% above year-ago levels. With the size of the breeding herd, those numbers are going to have to be much larger. And so we're looking at farrowing intentions well above 2%. And so that makes pig crops much larger. And to show where that impacted here this last quarter was that the March-May actual sows farrowing came in 43,000 sows higher than what USDA anticipated back in March. If you put that at commensurate pigs per litter at 10.63, that gives us a larger pig crop of about 460,000 pigs. That's about one slaughter day. So we're going to expect about one more slaughter day in the fourth quarter of the year. Now, we have the capacity to handle that, but that is going to pressure prices because numbers are much larger than we expected and come at a time of the year where you see relatively large slaughter numbers.
Let's talk a little bit about the demand. Where do you see that?
Well, I think in this period of larger supplies, we have to be thankful for the demand situation. Domestically, demand has been great. We're seeing prices nationally for pork at about $3.75 per pound. If you look at the first 5 months in 2017, it was $3.69 a pound. So we're paying higher prices for pork, and we're actually consuming more pork. So per capita consumption's up about 1.5% the first 2 quarters. So that's a very good sign for domestic demand. At retail, we're seeing featuring rates very high. So store circulars have a lot of pork that they're offering at very competitive prices when you look at the whole retail meat case. Also, exports have been up so far 9%. Now, we only have data available through April. We'll get the May data next week. But 9% is very important, that growth, because we have such larger supplies. We're up in production about 4% so far here in 2018. So we need those exports to really absorb this added production.
Do you think this trend is going to continue?
So I think when you look at the export market, USDA right now is projecting about a 6% growth. So we're definitely on pace for that through the first 4 months of the year, but also realizing that a lot of this data is not capturing the issues we've seen potentially with trade in the talks of tariffs, and those tariffs actually coming into place here starting in July. And so I think this is something we're really going to monitor. We're seeing right now, for example, Mexico is up 7% year to date in pork trade, but how do tariffs impact that trade? You could say similarly with China being up 14% for the year. You could see potentially tariffs having a large impact there. I think the real star market here has been South Korea, up 42% year over year. So that's really been carrying a lot of that momentum when we look at exports by volume.
What do you think about the price and profitability forecast?
Well, I think when you look at 2018, we're definitely taking a step back, both as far as prices and profitability. My price projections for the next 4 quarters, so the third quarter of 2018, is in that 67 to 71 range. Fourth quarter, all the way down to 52 to 56. As we look at the first quarter of 2018, I think we're in that 58 to 62 range. And then the second quarter of 2019, I think we're looking in that range of probably 62 to 66 in general. For profitability-wise, profitability has much taken a step back from 2017, where we've seen fair-to-finish operations average about a $12 per head profit. Here in 2018, it looks to be about a break-even profit, with large losses expected in the fourth quarter of the year, about a $25 per head loss. Now, that break-even profit does cover all economic costs, so producers can operate in that environment, but not long term. So I think we're really potentially going to see an impact on production if we see these losses continue from fourth quarter into 2019.
Next week, Nebraska Extension educator Keith Gluen will share information on the upcoming Nebraska Extension Soil Health Clinic. In Nebraska, dryland corners can potentially have 11,000 corn plants per acre, while irrigated circles have up to 36,000 plants. However, when it comes to deficit irrigation population, it can be beneficial to plant lower populations to match water availability, either due to allocation or low-capacity wells. You can learn more about these irrigation strategies in the July Nebraska Farmer. On July 11th, the Nebraska Soybean Board and Nebraska Extension will sponsor the Glyphosate-Resistant Palmer Amaranth Management Field Day in Carleton, Nebraska. At the field day, there will be on-site demonstrations of projects for the control of glyphosate-resistant Palmer Amaranth in soybeans, and participants will have the opportunity to earn 3 CCA credits. In addition, Associate Professor and Urbana-Champaign Extension weed scientist Dr. Aaron Hager will be attending the event as the keynote speaker. We recently talked with Nebraska Extension weed management specialist Amit Jhala to learn more about this field day.
So Palmer Amaranth is already one of the most troublesome weeds to control in soybean, and now in last 2-3 years it has evolved resistant to glyphosate, and we have confirmed in south central and southwestern part of the state, and it is getting widespread nowadays. So it is very important to learn and know how to control in different soybean varieties. We have a number of projects. One of them is to see how soybean row spacing and herbicide programs can affect management of glyphosate-resistant Palmer Amaranth in Roundup Ready to Extend soybean. Plus, we also have a couple of projects about how to control this glyphosate-resistant Palmer Amaranth in balance bean as well as in analyst soybean. Both of these soybean varieties are not available commercially in the market right now, but it will be available in near future. So it will be interesting to see and get familiar with how to control and how to take advantage of this new technology for controlling this resistant Palmer Amaranth. Learning goal will be just take notes about what herbicide programs you can consider. It will also show the importance of timing of Palmer Amaranth removal in soybean that should not affect the yield of soybean, plus use of residual herbicides. We have a number of herbicides tested in our plots, and so it will be interesting to see and take notes out of this field day.
You can register online for the field day at agronomy.unl.edu/Palmer. Now with this week's weather forecast, here's Nebraska Extension Ag climatologist Al Dutcher.
Well, folks, here again for the weekly forecast. Finally got back from vacation, and during this last week we dealt with some thunderstorm activity last weekend, and then of course we had some regeneration of thunderstorm activity on Independence Day. A lot of that heavier precipitation on Independence Day laid across northern Nebraska and then slid toward the southeast, petering out as it moved toward the southeast, although we did have some localized heavy precipitation in a few localized spots in Omaha, Lincoln, and then well up along the border of South Dakota and Nebraska, and then the heavy precipitation last week, and that resulted in significant flooding issues in central Iowa and northern Iowa. So do we have more in store? Let's take a look at the upper air models and see what we have in store. And as we go to the upper air models, what I'll draw your attention to is we do have a broad area of high pressure aloft, basically from the Central Plains toward the southwest, with a trough over the northwestern United States. It will slowly make its way toward the east over the weekend. Low pressure at the surface situated over western South Dakota. In terms of precipitation, Really, most of the precipitation will be right along the Gulf Coast, interacting with that land-ocean interface. And as we get into tomorrow, that high-pressure ridge kind of expands and flattens out a little bit on the northward side. We do have low pressure indicated at the surface in southeastern South Dakota, but we see most of the precipitation well to the north across the Canadian border and to the southwest. And as we get into Monday, broad high pressures aloft over the entire country outside the Pacific Northwest. High pressure firmly in control over the central United States. Much warmer temperatures really start to build in next week, with most of the precipitation along this front going to be really confined to the upper Great Lakes. I think it's going to be a very weak returns here in Nebraska, and then we start to see that high pressure system expand toward the north. We do have high pressure systems situated basically over the central and southern plains. Very warm conditions, basically in the low to mid 90s. We see some precipitation with the monsoonal flow trying to make it up into the mountain region, but pretty much we're staying dry here in the central plains. As we get into Wednesday, we start to see this ridge trying to back build a little bit toward the west as we see a trough working over it on the east. High pressure over the northern plains, a little low pressure over here in Oklahoma will at least lead to some convection across the front range of the Rocky Mountains, possibly into western Nebraska, but for the most part we stay high and dry. Then we see that ridge expanding on Thursday back into the Great Lakes region. High pressure to our east and to our southwest will keep most of the moisture out of our area. They will be confined to the Great Lakes and, of course, to the southern Rockies. High and dry over the northern Rockies and northern plains. And then on Friday, we basically see the start of a zonal flow along the Canadian border. We do see low pressure indicated by the models up in eastern Dakotas and to the southwestern Kansas. But in terms of precipitation, most of the convergence once again lies over the eastern United States with high and dry conditions over the northern plains and the Pacific Northwest. And as we look to the forecast for next Thursday, the following Tuesday, the heat continues in earnest, will remain back in the 90s. And in terms of precipitation, below normal precipitation from the northern plains all the way through the central plains. The biggest issue for us is going to be the high humidity levels and high index values for our cattle.
Thanks, Al. Today's interviews are available individually on the Market Journal website and through the Market Journal mobile app. They include information on corn and soybean markets, the 2018 Farm Bill, hog markets, and the upcoming Palmer Amaranth Field Day. As always, you can keep up with Market Journal during the week by following us on Instagram, Facebook, and Twitter. Next week, Doug Simon from Tradus will join us to discuss corn and soybean markets. Until then, thanks for watching. I'm Jerry Renaud, and we'll see you next week.
Join Market Journal online at marketjournal.unl.edu. You can also follow us on Twitter, Instagram, and Facebook. Promotional support is provided by the Nebraska Farmer Magazine. Market Journal is produced by the University of Nebraska-Lincoln's Institute of Agriculture and Natural Resources.